Made in America meets blockchain meets e-commerce. It's hitting a lot of the sort of hot button zeitgeisty things here. USAstrong.io is the website we're talking about. Chrissy Mashinsky is the CEO and co-founder, and Alex Mashinsky is the co-founder as well. And he has been a guest on the program talking about crypto as well. Chrissy, let's start with you. This website has been up and running for more than 6 months now. You're a retail veteran. What led you to see that there was a need here for this kind of a product, for this kind of a demand for USA-made products?
Yeah, thank you for having me on the show. It started with really starting my own brand and wanting to try and find manufacturing locally to make those products, and trying to verify what was really made here versus not made here is where that demand started. And as I started it, I realized there was a big opportunity to verify locally made products.
Chrissy, have you had difficulty finding products for the business? Because as you know, just looking at Amazon's site, they're taking products really from anywhere. A lot of the products coming from overseas. What have you seen?
Yeah, it's interesting. That's a great question. What I learned was you can actually say made in the US online without any repercussions, even if it's not. And that's really what piqued my interest. And you really have to dig into the verification, right? And so what does that mean? It's about seeing it firsthand. And that's really where the blockchain technology comes into play. And it's not about the difficulty of trying to find it. It's the difficulty of verifying it. That's what I would say is difficult. There's probably 500,000 manufacturers in the US. It's really about showcasing them and bringing them to life. And that's really what USA Strong IO is about. It's highlighting those manufacturers. It's showcasing them, it's verifying them, and that's what we do every Friday. We have local Fridays where we go to Main Street, America, and start to showcase all of those wonderful suppliers.
And Alex, you're the more on the blockchain side of the equation in terms of your experience and background. So Chrissy mentioned that it's sort of a verification tool. Can you walk us through that in a little more detail, what exactly blockchain brings to the experience?
Sure. So first, it starts with the curation. I think there's no place you can go to today and find a curated list of all the local manufacturers or U.S. made products that are verified as U.S. made. As you know, the President Biden and others have been stressing this issue that you can basically just put a fresh paint of coat on anything and claim that it's made here. But basically, what we do here at the USA Strong is look at all the components, right? Look at the supply chain, put all that together in an immutable way, meaning both the manufacturer or the producer tells us what they make, and then we verify that with the supply chain and record all of that into an immutable blockchain that records and collects all this data. So anyone who buys an item can verify, can look at that verification, attestation, and so on. And again, that data is immutable. So even if you sell that item to somebody else, they can go and verify all of that all over again. So I think we need that because, again, today it's very difficult to know what's true and what's not true. And pulling together the supply chain, making sure it's local, is also supporting not just the party or the entity that sells you the item, but also all of their dozens of suppliers across the nation.
And Alex, I guess, to you, does this feel like sort of how we're starting to offer some more tangible applications of blockchain that I think, consumers can get their heads around? I think what you just described is something that someone who's not necessarily a crypto expert, I can follow that line of thinking. Is this what, the space needs for people to more broadly perhaps adopt blockchain applications other than, as these kind of very in the weeds developer community projects that seem to today be still driving a lot of the conversation?
I totally agree with you. I think there's a disconnect between the consumer, even again, the supply chain, and the techies who are sitting in the room and dreaming up what we're going to do in 5 or 10 years. So what we've done here is very tangible, very immediate. It does not create additional overhead or pressure on these suppliers. It's something that actually helps them manage their inventory and manage their relationship and payments and things like that. And basically, USA Strong does it effectively for free by enabling larger consumption, a larger demand. We aggregate the demand and we aggregate the supply and enable a new channel that is not your Etsy or is not your Amazon that charge you between 30 and 50% of the value created, but rather only 10%. So you get the benefit, lower costs, and the winner is the consumer and the manufacturer rather than Amazon or Etsy.
All right, we'll have you back soon, Alex, to talk pure Bitcoin stuff as well. Interesting concept. Look forward to checking it out more. USAstrong.io co-founder and CEO Christy Mashinsky and co-founder Alex Mashinsky as well. Good to talk to you guys.
Myles just mentioned Nextdoor said this week it plans to go public through a merger with a SPAC in a deal valuing the company at $4.3 billion. In its investor presentation, the company said it has 27 million weekly active users and that 1 in 3 U.S. households, in fact, use the platform. Nextdoor added it sees sales growing 44% this year to $178 million, leading to an adjusted operating loss of about $50 million. Sarah Friar is Nextdoor's CEO, and she joins us now. Sarah, good to see you here. Congrats on this deal. The last data I saw on Nextdoor, you were valued at about $2.2 billion for a capital raise in 2019. Now the valuation has been bumped up to $4.3 billion. Why that bump?
Well, largely due to growth. We're in hyper growth mode. We saw phenomenal growth in 2020. Our DAU, our daily active users, grew 50% year over year. And as you noted, we've now reached 1 in 3 households in the United States. And of course, we're global. So we're in 11 countries around the world, 276,000 neighborhoods. And in countries like the UK, for example, we're seeing that same build happen. Today, we're in about 1 in 6 households and actually a little bit under 1 in 5 in London. So with that scale, brings monetization, brings a great business model. And so the valuation has risen commensuratively.
And, Sarah, I'm curious how you guys, and you outlined a little bit in the presentation, where you see yourself sitting with respect to competitors. I'm looking at the graph here where you have, you're comparing the frequency of use that Nextdoor has to Instagram and Twitter and Spotify, Weather Channel, so on and so forth. What I don't see on there, which is where my mind went, was, your Angie's List type home, referral services. How do you think about the opportunity that you guys have there, relative to the opportunity you have against some of these social networks that, again, are a little more prominent in the presentation?
Yeah, I mean, for sure, we are a local network, a community network. And so that is why we do have as a comparison set a lot of the companies that you mentioned, where we excel, number one, in retention. So our 3-month all the way to 2-year retention is head and shoulders above those peers. We're best in class. I think the second thing that we bring is a really unique audience. So we do show a chart in the presentation that shows that people who are coming to Nextdoor aren't visiting a lot of the other social media sites. So for advertisers, that unique audience is a way to get their message to people they can't reach any other way. But to your point, we are building overall a marketplace as well, right? We have aggregated all of these neighbors and neighborhoods around the world. They come to Nextdoor for utility and they come for community. But on the utility side, often it's to find the best plumber in that moment, right? Where you have a leaky faucet. Maybe it's to find the best cup of coffee because you've just moved into your new house and you're getting to know your neighborhood. So of course, that allows us to really speak to those local businesses. We've done a lot of investment in the last 2 years in building out a business platform, an ad platform for them. It's been incredibly successful, as you can see from our revenue growth rate. And so that does start to bring us into the zone of folks like Angie's List, Thumbtack, who are actually our customers because they come to Nextdoor to be able to put in front of our neighbors those pros that they have aggregated as well. So sometimes it's a first-party return. So a neighbor gives you that recommendation you really need. And then sometimes sometimes it's coming from a great customer of ours that can also help you get to that pro in your moment of need.
And you guys also talk about the TAM for the business has almost doubled globally. You see it doubling over the next couple of years. And I'm just curious how much maybe COVID-related mobility trends are driving that, or is it more just Facebook and Google clearly have a chokehold on the digital ad market, but with the growing market, it follows then that there is a larger opportunity for additional competitors if they can gain a toehold.
Yeah, so there's two ways we define TAM. There's the TAM just first of all of neighbors coming to the platform. And what we see there is Nextdoor has an inherent network effect, a true network effect, right? When you join the neighborhood just got better for everyone else on the network. And so we know that when we start in a younger neighborhood, we'll see good engagement. But when we get up into our top quartile neighborhoods, we see an over 2x improvement in engagement. And so what that's doing is driving the TAM of neighbors who can come to the platform. So there's really good growth there. And of course, international only further bolsters that. And then what you're getting to is the digital ad market. So there's not an advertiser that I speak to that isn't moving their spend online, right? Print, TV, just getting harder. With digital, you can really target your customer. And so Nextdoor is part of that shift to digital. Where we are unique is we are hyper local targeting. So whether you're the local mom and pop coffee shop or whether you're the largest retailers in the world, folks like Walmart, we can make sure that you're getting your message into the neighborhood, and often in a really hyper local way. We can actually change the message in the app to recognize a neighborhood and maybe a piece of information that's particular to that neighborhood. So it's definitely helping drive our growth, and I think it's providing yet another new place for digital advertising to happen.
Sarah, it's Julie here. I want to ask you about content moderation, which I know has been a challenge for you guys, like it has been for most social networks. A little bit different for you guys because you do have that location attached to your users. And I know you have spent some resources on trying to fix, for example, some racist comments that had been in some of the discussions. So now that you're going to have more resources, what kind of efforts are you going to continue to put in or even ramp up when it comes to this area?
So this is a hugely important area, right? We have to earn trust every day. It's our number one core value. Nextdoor is really founded on trust. So remember, where we're different from other networks is, first of all, when you join, we confirm that you're a real neighbor in the real neighborhood. So we don't allow avatars and bots and people to have multiple, usernames and so on. So what that does is it brings accountability. It's harder to be completely obnoxious when you might end up standing, on the side of the soccer field with that same person. On top of that, we built out local moderation because we think it's important to have local context. But of course, technology also plays a part here. So we will invest in areas like machine learning and data science to make sure that we're catching content that may be inherently toxic in a neighborhood, right? We want to build out kindness. And then the other thing we've done is we've done a lot of work with behavioral scientists, some of the best in the world, to be able to put into the technology ways to just help you be more accountable and be your better self. We don't want to stymie tough conversations. It's incredibly important right now that we can talk about things like race, for example, in neighborhoods. And so to do that well, though, we often slow people down. We've done things like anti-bias training. We've done an anti-discrimination reminder, a kindness reminder, and all of these things just stop you in the moment, remind you that great neighborhoods are created with kindness. And we find that people often edit what they're saying, but they still post. So the conversation, importantly, continues, but it continues in a much more constructive way.
Sarah, I didn't catch this in the presentation, but when do you think the business model will turn profitable?
So the way I think about that is, while we can drive hyper growth, investors want us to keep investing, right? Our profile is as a growth company. Historically, I've often run to the rule of 40. Investors may have heard of that. So the concept is that you add your top line growth rate plus your EBITDA margin. And if that's above 40, that means that what you're doing is on a good course. So in a high growth company like Nextdoor, we will keep investing behind that growth, probably for many, many years, because of our ability to do things like take the platform and shift it globally. But we know we have a really profitable business model, right? It's a proven business model, gross margins over 80%. So if we do need to turn down investment, we can do that actually relatively flexibly to turn up overall profitability if our growth rate were to start to slow. So for now, definitely in growth mode, but something we keep a very firm eye on, and something that I've learned, through my years of working with great growth companies like Salesforce and Square, for example.
And Sarah, you're on the board at Slack, and you're on the board at Walmart. And you've been on that board at Walmart since 2018. I would imagine somewhere close to when you took over from Nextdoor. It's not very often you get to work with a family like the Waltons and a CEO over at Walmart like Doug McMillon. What have you learned since being on that Walmart board, and what have you applied to Nextdoor?
Yeah, it's a great question. When I was joining the Walmart board, I read the book about Sam Walton, and never was there a person more community minded. And so that was actually one of the reasons I got really intrigued by what they had built, right? Walmart is the ultimate Fortune 1, but also the ultimate community business, right? They are often the only store in town, and they often act not just as a place to go buy things, but as a meeting place, a place where communities can come together. And so that's certainly one thing I've learned. They're also global, right? We've done some amazing work with Walmart in countries like India. And so learning from Doug how he manages that global expansion has really been incredible. So I feel really gifted to have been able to spend time watching a company at that sort of scale, particularly with Nextdoor and the scale that we know we can build. Nextdoor should be a global concept. Everyone is a neighbor. Everyone wants to drive that community and needs that utility in their local neighborhood.
Everyone needs those $4 or $5 hamburgers that Walmart sell at a discount, low price. We will leave it there. Nextdoor CEO Sarah Friar, good to see you. Good luck on the transaction. We'll talk to you soon.
All right, well, as the SPAC boom continues, we are finally starting to see more companies come public via the SPAC channel that have a real business. They are not only growing revenues, but they are also making profits and growing those profits. One of those companies is Bolero, and the company's president and CFO, Brett Parker, joins us now to talk through the state of the business and sort of how you guys see things going forward. So, Brett, let's just start with what COVID has been like for you guys at Bolero, being able to keep your lanes open. Have you been able to, what kind of capacity you were able to operate at? And sort of as we sit here today with most of the country having lifted most of the restrictions, do you feel like you're back onto that, pre-COVID kind of runway for growth?
Sure. So, obviously early on, it was a very challenging time. We were shut down everywhere, but by the early part of May of 2020, we started to reopen in the markets where we could, beginning in Georgia and then expanding through much of the South and sort of following the regulatory framework. And, fast forward to where we are today, we have everything in our system other than 2 locations in Canada are currently open, and revenue has come back with a vengeance. So we're already doing more than all of the revenue that we were doing on a pre-pandemic basis when we look year over year for these weeks since the beginning of May.
And Brett, I have to applaud your team because your presentation was incredibly thorough. There is a real business here. This is not like other SPAC transactions. One slide in particular caught my attention. You expressed interest in the presentation on potentially forming a REIT. Now, how much land do you in fact own, and how close are you to forming a REIT?
So the current number hasn't been disclosed. I don't think we're yet at enough critical mass to do it. We have some that we own today. We're primarily leased, but we do have a significant pipeline of acquisitions of individual centers that are coming on board, and more of those deals include land. So the thesis is that we will build to enough critical mass to potentially be able to spin that out as its own entity.
It's Julie here. I wanted to ask about sort of spending on those properties. Clearly, as we're showing for the pictures, and anybody who's been to a bowling alley in the last 10 years, we know it's not sort of the sticky floored bowling alleys of yore that I grew up with. So where are you in terms of capital spending, in terms of renovating bowling alleys, and sort of what your goals are on that front?
So as of today, we're in the right around 300 centers that we have in operation. Of those, about 120 look like the fully upgraded experience that you're showing on the screen, and then the balance are, I don't want to say untouched because we have spent money in them, but there's a lot of runway there to continue to bring those further up market. And as we do that, we dramatically increase the revenue and profitability, and the returns are explosive when we reinvest in our existing centers. And then it's a similar profile when we acquire a traditional center and make the same upgrades.
And then, Brett, another part of the business that you guys highlight in here is what you're doing with PBA, the Professional Bowling Association, and some of the media assets that are associated with that. How do you see that part of the business? Because, wholly owned leagues, I guess F1 is kind of the innovator here, but it's become a much more attractive part of the rights market, I guess, if we think about it that way, for investors, and certainly something I'm guessing you're going to talk quite a bit about on the roadshow.
Yeah, it is. And, the PBA is really an interesting thing for us because we acquired in 2019 with essentially a two-part thesis. One is this can and should be a growing and profitable business as a standalone media property. And we're working very steadily towards that. And we've done a lot to add to the projection value. We set a new record in viewership. So we really moved that business forward. And then the second is it creates this flywheel of growth around the core business where viewers from the PBA, we have increased interest in bowling, which we can then use to drive them into our centers. And then when they're in our centers, we have the opportunity to create more viewers for the PBA. So that virtuous cycle just continues to spin and spin. So as a standalone business, it's a very nice media property to own, and I think it has a lot of upside. But its most significant dollar contribution, at least in the near term, will probably be in what it does to enhance the performance of the core business.
Brian, go ahead.
Brett, to moving forward, where does sports betting fit into your go forward plan?
So there's really two pieces to that. One is betting on the PBA, which is something that we launched this year in partnership with Fox Bet. And that looks much like betting on any other professional sports league. What's interesting is, being a stop and start league, there is an opportunity for a very significant number of bets per show. Because as the data feeds mature, which is something that we're working on, you can go from betting on an entire event to betting on an individual game, to betting on a frame, to betting on a ball. So there's a lot of opportunity there. And then the second piece, as part of our longer term vision, is to integrate that activity as a game of skill into the centers themselves so that the casual bowler has the opportunity to win real world prizes based on whether or not they can achieve a given thing. If we say, we'll give you X dollars if you can hit a strike. Do you want to make that bet? That sort of thing. So those are two different pieces. One happens in the centers and one happens related to PBA, but both are vectors that we're looking at.
Well, Brett, Brian Sozzi tells us that he one time rolled a 300, so I don't think I'll be taking the other side.
Twice.
I won't be taking the other side of that strike bet for him. But we'll see. We'll see if we get the team out to a Bolero lane for a little team outing sometime soon. Brett Parker, President CFO of Bolero. Brett, appreciate the time this morning. I know we'll stay in touch as you guys get closer to consummating the deal, coming public, and then hopefully hit the quarterly circuit here for those updates. Yeah. Thanks for joining.
Great. Thanks a lot. Thanks for having me.
XPeng is fresh off issuing 85 million shares on the Hong Kong Stock Exchange this week. China-based electric vehicle maker is now listed in both the U.S. and Hong Kong as it seeks to mitigate some geopolitical risk. Joining us now for more on the listing and the company going forward is XPeng President and Vice Chairman Brian Gu. Brian, always good to speak with you. Thanks for taking the time over here this morning. So take us through this. This is known as a dual primary listing. So that subjects the company to rules and oversight of both U.S. and Hong Kong regulators. Why subject the company that type of scrutiny?
I think this is it.
Sure. Yeah. Thank you. Very glad to be here, Brian. Now, dual primary listing actually, has a number of benefits. One is that the company can be actually listed independently in Hong Kong, which means that it does not rely on a listing status in the US to trade in Hong Kong. Most of the secondary listing in Hong Kong actually relies on US listing. So a primary listing gives us the independent listing and trading ability. Secondly, is that the primary listing in Hong Kong actually gives us the ability to be eligible for Stock Connect, which means that the China-based A-share investors can, through Stock Connect, buy our shares in Hong Kong, which will give us the access to the Chinese capital markets, which also allows some of our customers can be our shareholders, which is also always our objective. So those benefits outweighs the additional hurdles that we need to cross to be listed. But on the other hand, those hurdles also make our company stronger and more compliant because we now satisfy both the Hong Kong and US standards.
And Brian, it's Julie here. It's good to see you. So is this also a move to mitigate some of the potential current regulatory risk we are seeing come out of China? Are you, as an executive at a company that is based in China and listed in the US as well as Hong Kong, are you concerned that Chinese regulators are going to say, you're no longer allowed to do that and you can't list in the US anymore? How big a risk is that in your view?
Well, to be frank, our dual prime listing process, we weren't aware of these regulatory changes, so that wasn't really the factor that factored into our decision to come to Hong Kong. But these changes, which are introduced in the recent days or weeks, are very new. So we're really need to study it. But the good thing is that we already listed in US and now we're listed in Hong Kong. So we actually have a very solid footing as a dual listed company in global markets. So I think we're very confident that we can actually provide stable access for our development to the capital markets.
And, Brian, certainly there's been a lot of focus on the stock over the last, really 6 months or so. It's been a name that's been, caught up in a number of different trades. I'm curious, though, about the business, because you guys, along with a couple of your peers in the China EV market, reported some pretty positive data for the month of June in terms of sales trends. And I'm just curious, how that is shaping up as we get into July here, and we think back to, the trajectory you rode in the first half of the year, and how you're thinking about the second half.
Yeah, I think the performance of our business, as well as the overall EV sector in China, has been really strong. I think surprisingly strong. If you look at our monthly delivery, which we disclose every month, we've been probably more than doubling on an annual basis for the 10 or 11 straight months. So that's astonishing. And also we have reported in our quarterly earnings that our gross margin had been increasing every quarter for the past 9 quarters. So not only the volume is increasing, but profitability is strong. So I think we're really, having a strong momentum in China. And if you look at the industry, the EV penetration in China has gone from 5% about a year ago to 10% today. It's more than doubled for the industry. So I think there is a strong wind behind our backs. I think it will carry through in the second half, because I think the second half typically is the stronger sales season for auto. So we are very hopeful that second half will have a stronger growth. On top of it, actually, we will be introducing brand new models. One will be the facelift G3, which is our first model. Now we have a makeover in the mid-cycle. And then the fourth quarter will be bringing our third brand new model, P5, to the market. So with 2 new models and the existing growth, we're very confident we can deliver stellar growth in the second half.
Brian, since you and I last spoke, Tesla has really come under a lot more scrutiny in China regarding quality problems and how it sells its vehicles. Do you think XPeng and even some of your competitors are gaining market share because of these stumbles?
Well, I think Tesla is still very strong in China. If you look at their delivery numbers in last month, they came back very strongly. It has a tremendous brand in local market. Its products still viewed as a high technology and one of the potential leaders in a number of areas. And also, I think that they are being very aggressive with pricing. So I think Tesla is still going to be a very strong competitors, and I think that they have a very commanding market share. Probably not as high as last year when they have a very dominating share. But on the other hand, I think the Chinese players are catching up very quickly. Our product and as well as some of the other products that are being introduced by the leading players have very good and comparable specs, as well as better user, features compared to Tesla. And I think we're catching up very quickly. So you can see that in the last few months, our growth has outpaced the industry as well as Tesla in China. But I think it's a long race, because I think ultimately this market will not be dominated by one or two companies. It will probably be a number of players occupying probably large market share positions, for example, 10% and above. So that will probably likely to be the trend, and we hope to be one of those top players.
And Brian, I know XPeng had started to export vehicles, I believe to Norway late last year. Do you think it's important that XPeng goes global?
Absolutely. I think smart EV as a product should be a global product. You should not be just design a technology for one particular market, especially that technology will involve the entire powertrain, the battery technology, the smart technology, autonomous driving. So much investment going into this product should make it competitive globally, not just in China. That's why we actually started the effort in Europe. We start selling in small numbers in Norway. We are building our presence in other countries in continental Europe. And I think for the next 4 to 24 months, we'll probably be launching our operations in a number of European countries. So I think by probably 12 to 18 months, we should have our capability built up in Europe, and then we want to introduce products that be designed for international markets. So I think that will be when we start to see larger number of our sales.
And Brian, finally, I want to circle back to the listing, and in particular, just to sort of emphasize the point here, for U.S. investors, is there a message that you want to get across to them amidst the sell-off that we're seeing, of course, not just in XPeng, but in Chinese-based U.S.-listed companies broadly? Is there a message that you want to make sure American investors know about those U.S.-listed shares?
Yeah, I think one thing is maybe investors have to really look at the past and the longer horizon. I mean, Chinese ADRs has been one of the best better performing classes of security if you look at 10 years or beyond. So it has provided significant growth and opportunities for US investors. But also along the way, there has been quite a bit of volatilities. And, in years like 2012, in years, there are, similar issues have impacted the shares trading in the US. But in the long run, I think because China growth opportunity is still very compelling, I think investors, if you're taking a longer term view, will be very, very much rewarded.
All right, we'll leave it there. XPeng President and Vice Chairman Brian Gu, always good to see you. Thanks for staying up for us. I know it's almost 10 o'clock over there in Hong Kong. We appreciate it.
Thank you.
Later today, President Joe Biden is expected to sign an executive order aimed at what the administration is calling a promotion of competition within the American economy. The order is set to cover a number of areas, and joining us now to talk through some of the key initiatives within this plan is Bharat Ramamurti. He's a deputy director for the National Economic Council. Bharat, great to speak with you once again. I want to start with an area that jumped out to me within this, and has certainly gotten a lot of play in the business press, which is the executive order around non-compete clauses and around the licensing requirements for some industries. I'm wondering if you could just sketch out how the administration thinks about some of these issues and what exactly is in the order.
Sure. So 1 out of every 3 private companies has non-compete agreements for its workers, which means that limits the ability of workers to go switch to a better job for them. It has the effect of reducing wages and reducing competition for workers. And in fact, 1 out of every 5 workers without a college degree is subject to a non-compete agreement, right? These are folks working in retail, working construction, and so on. We're not talking about high-level executives. And so what the president is calling on the FTC to do is to examine non-compete agreements and take steps to ban or at least curtail the use of those agreements so that those millions of workers are going to have more ability to go switch to a job that's better for them. Same thing on occupational licensing. Look, some licensing is important for protecting public safety, for making sure that people are qualified to do certain jobs, but a lot of the occupational licensing rules that we have simply restrict mobility. And in fact, they restrict people literal mobility, right? They make it harder for somebody who lives in Florida under one licensing regime to move to Georgia and keep being a beautician or working at a nail salon where there's some licensing requirements. It's particularly burdensome on military spouses, 34% of whom work in an industry where there is a license requirement and they have to move every few years because their spouse is in the military. So what we are asking the FTC to do is to look again at the factual record, determine whether some of these occupational licensing restrictions can be eliminated so that workers have a better chance to move, have a better chance to find the job that's best for them. In the president's view, we are in the middle of a historic economic recovery, one that is seeing higher wages for workers, and these changes to improve worker mobility are intended to complement that.
Hey, Bharat, it's Julie here. I want to go back to non-compete for just a moment. And I know that that really affects probably the tech industry more than anything else, although some other professional services industries as well. I believe there is also some legislation out there that addresses this issue. So I wonder how this order is being viewed within the administration as being complementary to that, instead of that, as a tool to maybe help nudge that through. How are you guys looking at it?
Well, just one quick correction. You're right. It's prevalent in the tech industry, but it also affects, like I said, construction, hospitality, retail. 60 million workers are subject to this. For a long time, it was fast food workers. You worked at a sandwich shop. You couldn't go work at the sandwich shop across the street because you were subject to a non-compete agreement. Yoga teachers, summer camp counselors are subject to these agreements. So look, this is not just about high-level executives with deep institutional knowledge that's very valuable. That's point number one. Number two, as you note, there are solid bipartisan efforts in Congress to eliminate or restrict non-compete agreements. We would encourage Congress to move forward with that legislation. Of course, legislation can accomplish this more directly and potentially more quickly than working through the rulemaking process. So we don't view this as instead of legislative effort. We encourage Congress to move forward on that legislative effort. If a bill to ban non-compete agreements comes to the president's desk, he'd be happy to sign it.
Digging deeper into this executive order, Bharat, I'm seeing that it says that hospital mergers can be harmful to patients, and you're encouraging the Justice Department and the FTC to review and revise merger guidelines for hospitals. Now, hospital CEOs will say they have had to merge through the years because margins are slim here and they have to gain economies of scale. And if they can't merge, they might have to close hospitals down. What's your message to them?
Well, look, the data shows that there has been quite a bit of consolidation in the hospital industry. That's been particularly harmful for rural communities because what happens is that hospitals consolidate and they shut down the hospitals that operate in rural communities. What we've seen is that after hospital mergers, prices go up for patients by as much as 20%. And by the way, on the wage side, too, research has shown that after hospital consolidation, wages for nurses and administrative staff, the wage growth declines. And so we think that there are real harms to consolidation in the hospital sector. What we are asking the DOJ and the FTC to do is really scrutinize these mergers and make sure that at the end of the day, what's going to happen is a better outcome for patients, a better outcome for people who work at hospitals. We are not prejudging any particular merger, right? It's going to be up to the DOJ and the FTC and the expertise that they have at those agencies. What we are trying to do is point out that this idea that consolidation leads to more efficiency, it's just not borne out in many cases by the evidence.
And Bharat, we keep alluding to how sort of sweeping this bill is, how many different, this is, how many different industries it affects. From an economic big picture perspective, what is the administration hoping this will achieve?
Sure, I think it's very simple. Lower prices for consumers, higher wages for workers, and I want to make sure we hit this point, a more dynamic and innovative economy. We have seen a host of research come out over the last several years about how when industries are more concentrated, there is less investment. There's less investment in R&D specifically. fewer patents are generated. In other words, as industries get more concentrated, there's less competitive pressure on them to be innovative, to come up with that next great idea to secure customers, because they have a stranglehold on the customers, right? So what we are trying to do is by promoting more competition in these industries, not only reduce prices for consumers, but put pressure again on companies to really invest in innovation, invest in training their workers, all so that they can try and produce better products, better services, and attract customers in a truly competitive environment.
And Bharat, finally, before we let you go, we are certainly still in the midst of the pandemic, but we see the economy rebounding as we start to exit some of the most acute impacts from it. And as you guys on the Economic Council think about where this order fits into the future of the U.S. economy, how much is in response to maybe what our shortcomings were as this pandemic broke out, compared to other initiatives that yourself or other members of the council have for a long time looked at as things we needed to do in the U.S. economy, regardless of whether we had a recession, pandemic, otherwise?
Yeah, it's a good question. I mean, look, I think this is about responding both to a long-term trend towards increasing concentration across a number of industries, and short-term issues that arose during the pandemic, right? So, for example, there's been incredible consolidation in the meatpacking industry. And when we saw that one of the major meatpackers was affected by a cyber attack, that led to an enormous increase in prices that folks were being charged. And if we had a more diverse, more competitive industry, some of those effects would have been mitigated, right? And so increasing competition is not just about, in the long term, more growth and lower prices. It's also making sure that we have a diverse set of companies that are available to step in case something happens to one of them, which is critical not only for consumers, but in many cases for national security.
All right, we'll leave it there. Bharat Ramamurti, Deputy Director of the National Economic Council. Bharat, thanks so much for spending some time with us this morning. I hope we'll be in touch.
Rebuilding closets for life after the pandemic powered Levi's to some impressive top and bottom line gains in the second quarter. The company smashed analyst earnings estimates by 14 cents and issued second half guidance that was well above consensus. Shares are up about 3% so far on today's session. Joining us now is Levi's CFO, Harmeet Singh. Harmeet, always good to see you. I'll start with this. My Twitter feed is on fire right now. I put out this stat you all shared on your earnings call last night. 35% of consumers in the U.S. have changed their waist sizes because of the pandemic. What has that meant to your business?
Good morning, Brian, and everybody on the team. It's great to be here. We had a wonderful quarter. As you know, we beat top line and bottom line expectation and raised the outlook for the second half of the year. To your question about the increase or the change in sizes, what it means is that people are out there shopping. The category, apparel as a category, has expanded. Denim has grown or is growing faster than the category. And for market leaders like us, as we set trends, we set the trend on the looser silhouette, the wider silhouette just before the pandemic. And our looser, baggier fits now account for about half our business and growing. And as people return to work, casualization trends, tend to gather pace. It really bodes well for brands like us as people trust our brands and, importantly, return to work with more denim in their closet.
Harmeet, I went to the mall by me over the weekend, and really so many things are out of stock. I picked up a pair of Levi's jeans. I looked at the price on the tag, and my thought was, wow, these are pretty affordable. Levi should be charging more for these because jeans are so much in demand. Have you been able to push through price increases, and are you going to implement more in the back half of this year?
Our products give great value to our consumers, we're very pleased with the momentum we are seeing and have seen over the years. To your question about pricing, we have successfully taken pricing even during the pandemic and continue to do so. I firmly believe we have pricing power. It's always better to price when the brand's hot, the products are relevant, than when you need to price. And we continue to do that. Our AURs, in the quarter were up 5% globally. And our view is we are in the early innings of pricing. And as we introduce more innovation and relevant products, take our loser baggy of fits, they are high AURs, they're priced a little higher and resonating really well with the consumer. So it's clearly an opportunity for us. We are also using AI and data analytics to manage promotion, to determine where we can price and where we can't. And that's making a big difference.
You know, Harmeet, we're talking about taking pricing here in the U.S. perhaps as we see, you know, some bit of an inflationary backdrop. But you guys talked a little bit about what you're seeing in Europe and where, you know, you are, as you guys mentioned, a market leader in that market. It's been a little bit more challenging with the pandemic and their economy. I'm curious how you could, if you could outline for us the trends you're seeing in Europe and maybe how far behind you see that recovery relative to what you've seen in the U.S. business.
You know, our brand has been on fire in Europe pre-pandemic, and the team has done a phenomenal job being agile and responding to the changing situation. I'm empathetic to the folks and consumers on the ground, as all of them have been through lockdowns. But the good news is the lockdowns are lifting, and as we exited May, you know, our business in Europe was actually already showing a high single-digit growth relative to 19. During the pandemic, you know, we made a real pivot to e-commerce and digital. Our digital business is up and growing big time, you know, has doubled over the years. And as the lockdowns lift, you know, most of our doors now in Europe are open. During the quarter, about 30% of our doors were closed. And so business was down relative to 19. Business is recovering and growing relative to 19. So I'm very we're long in Europe. We have a huge potential, and importantly, you know, we've been able to take pricing as well as our products are resonating with our consumers.
Hi, Harmeet, it's Julie here. You mentioned the increase in the direct sales channel, which I believe was up 75% year over year for you guys. Does that have, I imagine the margins are better when you sell that way. Does it also help you in terms of inventory management when you have that sort of direct channel to the customers and perhaps better insight and data on them?
Yeah, no, it's a great question. Structurally, we're emerging from the pandemic a much stronger company. And let me explain that. Digital is a higher mix. So if you take the total digital ecosystem, it's about a fourth of our business. It was in the mid-teens pre-pandemic and growing. I mean, our entire digital ecosystem was up 75%. And that was on the back of a strong quarter a year ago. It has higher gross margins. We had our third consecutive quarter of record gross margins, and we raised our guidance for the year. More importantly, what it does is it allows us to connect directly with our consumers, and we're connecting directly. We're reaching out to the younger consumer. We introduced the app, an app in the US, and 70% of the users on the app are younger consumers. And so it allows us to engage with them directly, allows us to offer our latest collaborations and our assortments, which are head to toe, directly. And I think it's definitely making a big difference and allowing us to exemplify and endure our brand.
Harmeet, are you having difficulty finding workers to work in your retail stores?
You know, the good news for us is that our attrition rates are lower than the others. We are responding by ensuring that the total rewards that we offer to our employees are competitive in the marketplace. We are seeing normal pressures, but we have been able to withstand them and ensure our employees are servicing our consumers with the same service levels that we maintained pre-pandemic. So the quick answer is we probably will see some wage inflation, but we're able to withstand that just given the brand we are and the service levels we provide and the benefits we provide to our employees.
All right, I'll leave it there. Harmeet Singh, CFO of Levi's. Good to see you. And good to see you back in the jean jacket. Last time I think we caught you in more casual look, but good to see you back in your trademark piece of apparel.
Thank you, Brian, and thanks for having me on your show.
Thanks so much.